All right, welcome everyone. This is David Morgan of themorganreport.com, and this really is an interview. It's a conversation. John Sneisen, I'm not sure how to pronounce it. John, known each other for years. I'm terrible on names, but thanks for joining me. And we're just going to have a talk about, the present day economic system. John, what's the name of your website?
Yeah, you can find everything about me at theeconomictruth.com, of course. That's where I have everything. You could find my books there, The End of Freedom, How Our Monetary System Enslaves Us, or Canada, the Greatest Economy in the World, which is, a book that I wrote in 2016 before Trudeau got in and destroyed everything. So you can find everything there, my blogs. You can find my Telegram. I do post, for those that are interested, I do post like news articles that I found very useful and that I look at myself onto my Telegram on a daily basis. So, but you can find all that at theeconomictruth.org, my website.
Great.
Yeah.
Well, we had a bit of a chat before we started the recording, and I think to review the basics, and this is one of several things that people have a hard time even believing. One is, and everyone that's probably tuned into our channel knows this as a fact, and that is that, the system is set up where the bankers can create something for nothing. They can create money out of thin air. And, as a finance student years ago, most people that were in the class with me when that was taught to us, they just dropped their jaw in amazement. No, I mean, that can't be true, and it is. The other part that I want to stress is that you don't own your own money. And that is, I think, where we want to start this discussion today, because there's been two things. One, I did an interview with Stansberry Research. I guess it's been about 2 years. And I talked about the bail-ins and the fact that the bank considers any depositor to be a non-secured creditor. And once you deposit your money in their bank, it's their money, not yours. That's a fact. Now, that's something that a lot of people that have followed us may not have heard, or heard it once and kind of blown it off. Oh, that can't be true. I signed a signature card and, that's my money. No, it's actually theirs, and that's been proven. Trudeau was one of the best to show you in Canada with the trucker strike that he confiscated accounts of the people that were politically incorrect. I'll put it in those terms.
Yeah.
So coming back to this, there's been a book that's written that's hitting our circles rather hard called The Takings by, I believe it's David Webb. And he talks about the DTCC. And basically, not only do you not own your money in the bank, but you really don't own your shares in a brokerage account. It's actually held in the street name, and that book is scary. Basically, what he said is that you don't own anything. The idea that what the WEF has said, you'll own nothing and be happy. Actually, the legal framework for that exists today. So can you comment on that and go any direction you like, John?
Yeah, no, for sure. That it's pretty scary because I remember, I think it was like 2-3 years ago, I started to look at, and I forgot who introduced me. I think it was I got introduced it to with a friend of mine called Tim Pichotte. He's called Liberty Advisor. He's a financial advisor that I did a whole bunch of shows with called the Tim and John Show. We did I think like 80 episodes, starting actually right at the repo crisis. That was our first episode, so we kind of like focused on different things like that, and then we found out I forgot her name. Oh, Whitney Webb was it that introduced us to, the TCC, the Depository Trust Trust. Corporation, the DTCC. Anyways, what they do is actually they hold everything. They have all the stock certificates and everything at their disposal, and they're also what's called a central clearing party. Okay, so central clearing parties, there's multiple of them around the world, and the DTCC is the American one. Now there's ones in Europe that are called I forgot what it like. I could probably like find a document where they're all listed, anyways, but in this FSB report, the Financial Stability Report that I read upon, they talk about the central clearing parties and risks surrounding them and so on. But in there, it becomes very apparent that they hold all these certificates or whatever they have, and they control, what they do is that they make them available for trading for, the New York Stock Exchange, and then also for all the banks through their trading accounts that they have, right? And so they are the ones actually running the back infrastructure for these banks. When the trade happens, when I sell a stock and you buy it, that exchange is then being done on a ledger that is run by a system that the DTCC then swap around the street name titles of who has the ability to be able to receive the dividend and receive the profit of us or loss on that stock or share that have been bought or ETF, whatever type of asset it is. And they also, like every derivative assets that's out there, they also hold titles to, and then they divert that to the global banking system. And so basically a gigantic trust that owns all this, and they control the actual intrinsic title onto this. Like they hold the title onto those assets, and then they give us and the banks, even like not even the banks really hold a proper title to them. Like they hold them in our name. I think they might hold the physical title. Don't quote me on it, but the actual RBC or Bank of America, Citibank, or whoever owns the title on a share for you in your behalf, or if it's BlackRock, whatever it is. I think they might have title to it, but I maybe they don't even have title to it. The big banks. Maybe it's like, not to become too conspiratorial there, but maybe it's the way that they're talking to us, the elites. The World Economic Forum, Klaus Schwab's. Like you own nothing and be happy kind of scenario. Maybe they have a little bit of understanding of what's going on there. Of course, in the global banking system, but who knows who actually who owns shares, by the way, in the Depository Trust Corporation, the DTCC, like who actually owns shares for that, because it is a corporation, right? So who actually owns their shares again? Is it the bankers? That's probably good, valid questions that maybe if somebody's really smart and have a lot of good connections, maybe they'd be able to cough up, some shareholder information on the DTCC itself. But it'd be very interesting to see, anyways, because when it comes down to it, then what I focus on a lot is you got to be off the grid, financially and with your own belongings. Like if you own anything, if you owe anything in debt towards any of your assets, it's easy for them to just swoop in and then take. And actually, what they'll do is they'll recall your loan, and then you're gonna have to pay it. Well, if you don't have the money, they're gonna take possession of your asset, right? So there's a lot of that, I think, potentially common. And David Webb's book, I haven't read it myself, but I've got a good overview over it from Matthew Smith and Doug Casey on it, and they really gone into great detail of what happened during the Great Depression. It was a lot of wealth confiscation, where people found out that they don't own their assets, they don't own their shares, they don't own their if they had, there wasn't ETFs at the time in the way that we have now, but people found out that their wealth got confiscated. If it was held in in your secure deposit box at the bank, they could go in there. That happened actually just recently during the bail-ins over in Cyprus, but I think mostly in Greece. Actually, they went into people's bank deposit boxes, because you don't even have rights to that.
Yeah.
If you thought that you actually had rights to it, well, you lend it to the bank. That's kind of matter of fact. Same with your, of course, your your deposits that you have in your bank account. That's not yours. You just lend it to the bank, unless you have it in physical cash, and not even cash today. Like they could just evaporate that into nothingness. So you really don't have a lot of things to protect yourself. But through all history, we've been taught, many times through failures and tribulations, both banking and in monetary systems, we've been taught some good lessons on what probably is the best protection that you could have. And that most of the time, that is real things. That's your food, that's your house if you own it outright. Now, problem today, if you pay a property tax, you don't own your house. The government owns your house. So but try to own things that are real, that is not based upon any way that they can manipulate it or just swoop in and then take it, especially if it's anything electronic. It's very risky. It's highly risky. They could, if they get crazy enough, they could just shut off the internet even. So even if you did have, crypto assets and all that, like it's even risky as that. So like I do like crypto. I know that you might not be a big fan, Dave, but one of the biggest things is like looking at crypto. I still like my massive, by far biggest holding is in precious metals because it's the safest and securest that you can have. Like, yeah, you could come and try to rob it from me, but you probably feel pretty miserable trying to do it. But yeah, I think we're coming to fruition in probably most of, like, it looks like, because there's a lot of countries around the world that are facing massive debt problems right now, and it comes to like the debt issues that we had around the world. Like I was just looking at a report from the Financial Stability Board, and they now include non-bank financial entities, and they found out that we're sitting at around, in the G5, we're sitting at close to 500% debt to GDP. It's just unheard of, and of course, but the thing is, we live in a debt-based system, and it's a Ponzi scheme. So think about this: when if you replace the investors that's coming in at the bottom of the Ponzi scheme with debtors, then you get actually like a full insight in how our monetary system works quite quickly. Because when you lose, when debtors default and when they can't pay anymore, actually, that's really, really, really bad for the monetary system, and it can't survive with actually going into negative, called deflation. And so, if that happens, and we're starting to see that now, we're starting to see M2 in the United States has gone negative. And when was the last time that happened? That was during the Great Depression.
Depression.
And what happened then? That's exactly what we've been talking about, right? So there's some huge warning signs, and of course, in a debt-based monetary system that we have, you can't have shrinking debt like monetary levels, and you have to constantly issue more and more and more debt to pay off the ever-increasing debt and interest.
So you outlined a little bit about how much of I'll call it, for lack of a better term, haircut the bond markets have taken because of increase in interest rates. Can you just go over that briefly? And then after you answer, the kind of discount you would have to sell the 30-year for to, raise cash. Could you then from there move on to what do you think is going to happen in the bond market? Do you think that there could be a default even at the long end of the curve, or do you think they'll just keep printing money? I'll answer the question. I want your comment. To me, there's really two scenarios. One is you do a default. So you mark you do anything that you do in real life. You mark to market. In other words, this asset, be it a debt instrument or not, I got a bunch of dresses that no one wants to buy. So I just keep marking them down until they sell in my dress shop. Well, the same thing in the monetary sphere. I just keep marking the bond down until someone wants to buy it. The problem is, that 500 to 1 is a real problem. But coming back on point, there's a way to make it solvent, and that is to flush out the system. The other part is what's most likely, at least in advanced economies throughout all of history, and that is you just print. You make the interest payment on that debt, but then the currency becomes worthless, and no one trusts it. Now you really got a problem, because now you've got to do the reset and start over, which, of course, in the behind the scenes, we all think that the bankers have this master plan to push the reset button and put us on a CBDC or a different platform. So I said a lot, but where's the bond market at now? Where do you think it could go? Do you think either one of those scenarios could take place, or have you got a different perspective?
Well, the bond market is in huge distress. There's only been a few times throughout history, actually, when bonds and stocks have lost at the same time. And that was, I think the first time was right before the Great Depression. It was the first time. And then I think it was in the 60s, right before the 1971 reset. And so I think we're heading towards a reset, because both stocks and bonds are down still. Like the stocks are still not above their, 2012, was it 2021 or 22 high, right? Still. So they're not seeming to be able to recover. And we have a huge deflationary pressure, it's especially through the demographics that we have as well. Harry Dent is a fantastic demographer, and he's kind of talked about this. But where I think he is wrong is that he thinks that we're just gonna let it go. And I just don't think, because there's a speech done by none other than Ben Bernanke in 2002, before he was like a governor of the Federal Reserve. And in that speech, he actually wrote that, if we do get deflation, we could only comfort ourselves that we always have the comfort blanket base. That's not the exact quote, but the comfort blanket of the printing presses to protect ourselves. So basically what he said is that they will buy assets, they will purchase everything. And I think they're gonna, during COVID, I looked at all the central banks in the world, and what I found was that there's lots of them that had to go and buy stocks. They bought ETFs even. Several of them, like the Norwegian central bank, Norges Bank, bought 4% of Oslo Børs, which is the Norwegian stock exchange. And so they had to go there and bail them out, basically, in order to control complete failure. Because what ends up happening, and this system is based upon trust, is that if that trust link breaks, it goes south very fast. Like, this is why I have a wall behind me with hyperinflationary currencies. I collect hyperinflationary currencies, and I have like 30 of them in here. And that's what happens, is that the link of trust breaks for these currencies. And when that breaks, there's no way back for the government to restore trust in the value of the currency. So what ends up happening is the people would just start, either trying to get rid of as much as they can at a fast pace, so you get what's called velocity kicks up. And then what ends up happening is you get a massive supply. So we got supply and demand. You get a massive supply of currency coming and chasing, one to buy real things. And then you get the hyperinflationary shocks. And then right after that, you get another shock upon shock. And then basically people are getting rid of whatever they can that are, in the current monetary system. And so you just get a rush out of that. But then what happens is and people stop probably using it in transactions. So what ends up happening is the government is not going to be able to collect the taxes. So they have to print. And that's where you get that big print coming from the government to try to rescue themselves. That's what happened in Venezuela just recently. So you got to print, and then just like another shock to the currency is completely gone. Like, usually that process takes from 1 to 6 months. So that's just a historical scheme. But let's go and look at, like, I have a list here, and I got to give a big shout out to a guy that I follow on LinkedIn. His name is Rebel Cole. He's Lynn Eminent Scholar Chaired Professor of Finance. And so he actually recently came out with a list of over 77 banks. And he looked at, their balance sheets and how much losses they have on different, so he categorized it into 4 different categories. And the one is percentage loss on government securities, then residential mortgage-backed securities, then commercial mortgage-backed securities. Then they looked at what's called asset-backed securities. So asset-backed securities are just securitized student loans, credit cards, car loans, and so on. Like, that's asset-backed securities. So it's the same as a mortgage-backed security, but the debt is just different. It's consumer goods, right? So, but if we go and look at some of these banks, and we should look at probably the bigger one, that's on here, which is, of course, it's a bank that's, a primary bank. It's one of the major banks in the United States. It's Bank of America. Now, their losses on his sheet here estimate right now, it's not, of course, you talked about the mark to market, right? And if you mark to market, their actual balance sheet, they'll have a loss of $108.853 billion right now. And where their biggest amount of losses come from, it's actually they lost 80.3% on their residential mortgage-backed securities. So this is housing in the United States.
Let me stop you, John. I have to make a joke, and I hate interrupting.
Of course.
Real estate only goes up. What are you talking about?
Oh, shoot. Yeah, that's a big one here in Manitoba, where I'm from. In the capital city, they had think 30 years of just up and up and up. And then they had 2 years where they lost -2%. And then like everything has been up. So everybody, yeah, like real estate will always goes up. Like I hear this from just the reason I listened to a real estate, a Remax broker from Toronto. He was talking about how, like yes, they have 7% loss now. Like of the sales, 7% of those sales are in lost territory now in Toronto itself. And so he's like, well, there's nothing to really worry about for the future. Like if you buy, and hold for the future, it's all good. And this comes back to, again, like, yeah, let me just sidestep for a second, because I always have talked to so many financial advisors around, especially mostly in the vicinity here in Manitoba. And all of them are like, well, you invest for a long term, that's how we get wealthy and rich. But then I ask one question, ask your financial advisor a simple question, and that is, what happens if we do get a big recession or a depression that happens when you're about to retire? What's going to happen to my portfolio? Because now you're retiring, you have to withdraw at the same time as you lose it massively. And so like the accumulated losses, in your portfolio would be massive on that, right? So that this is not a good scenario that we're in. And we're going to see that with this bank list, because of course, Bank of America is one, but there's like 77. These are some of the bigger banks, and there's 77. All these banks that have heavy losses. Like there's been a lot of talks about Charles Schwab, bank, and their losses are 23.5 billion. Now, their biggest loss comes from real estate mortgage-backed securities again, with 66.3%. Now, here comes another surprise that might surprise people a lot, which is this is interesting, right? Like okay, so they got some losses here, but what about bonds? Bonds should be the most securest thing in the world. Like we should never that's where everybody floods to for security, right? Well,
Right.
so okay, so what happened with a lot of these banks during COVID? Well, the government lockdowns. We shouldn't call it COVID even. During the government lockdowns, what ended up happening is that the government sent out mass amounts of stimulus, and these banks, they had to then, because as a bank you need an asset and liability. The liability is the borrowed money, the deposit in your bank account. The asset then they would have to cover it would be a bond, and so they bought a lot of them bought long, like there, I think 30-year bonds that were issued at near 0%. And then now, they're looking at like, oh, what if I sell it now? Well, now, what is let's say 10-year right now is 4.8 something, 4.7. I forgot exactly where it's sitting right now. So you get a massive, massive loss on that. And there's banks here like Citizens Bank sits on 97.0% loss on their bond portfolio. There's a Union County Savings Bank. They have 93.2% loss on their bond holdings. You got CBNS Bank that they have 98% loss on their bond portfolio. You have let's see if we can find like here. So just some other ones. Let's see if we can find any bigger banks on there. Farmers National Bank, 51% loss on their bond portfolio. But if you go and look at actually the commercial side, so the commercial mortgage-backed securities, there's one bank that is in big trouble, and that's the Greene County Commercial Bank. They have 50.3% loss on their bond portfolio. They're a New York bank. But if you look at the total losses, this is interesting because now their leverage gets exposed, David. And as you can see here, so if we go by the banks, so these banks are actually ranked from number one with the biggest amount of losses on their CET1 capital, right? And so like now it becomes apparent that they have leverage because first Republic First Bank has 143.4% loss. You got the First American Trust has 125.3% loss. You got Citizen Bank has 124.2%. Principal Bank, they have 114.5. You got Union Savings Bank, 110.9% loss. You got Green Dot Bank, 109%. And like the list goes on and on. I'll share it with you so you could share it with your with your readers. But again, it becomes pretty apparent that like anything that's debt based, that is also like, of course, all the derivatives that are dependent on certain interest rates and so on to be a legitimate investment. And then, of course, when the investors dry up in these derivatives and they can't pay, um, uh, the the people that actually are the underlying debt on this, the people that drive their cars, that have their houses and so on, they can't pay their debt because of high interest rates. Well, now you're going to have a cascading massive failure of these assets. One thing that was very interesting, I interviewed recently, David, a lady that used to be a specialized journalist in mortgage-backed securities and collateralized debt obligations from 2005 to 2008.
Hmm.
And it was very interesting. Her name is Alison Pyburn, and she was telling me, her friends that used to be journalists with her, they're sitting at high bank positions right now, or they ended up at the rating agencies and got some good high-paying jobs. So she's one of the few that are left that actually, have a conscience among these people. But she was telling me, like, so how it works in the derivatives world is you start with good debt, and you collateralize that into these derivatives. And then you keep on, like, so the collateralize, because they want more and more of these derivatives. Well, now you got collateralize more and more debt. So you keep on like going down the chain and down the ratings of, good debt to really bad debt. And so at the end of a cycle, they take all the garbage basically, like that they know is useless, and then they have to collateralize that as well, and that ends up on balance sheets. And I remember 2008 where Norwegian pension funds for the local counties in Norway, they ended bankrupt, and they still are in trying to get their money back from the funds in the United States that sold it to them. And so all this collateral, all these debt, and of course, like the derivatives that are in the quadrillions on top of everything, right? Like all of this stuff is just a massive inflated balloon that is ready to pop, and it's gonna be quite the ride, because people are gonna realize, first of all, that their assets are worthless, but second of all, that their assets that might have some value might be just confiscated, during this process of reset. And so it's going to be a very interesting and very risky, period that's ahead of us. And I think it's coming very soon, because like the mortgage markets in the United States have completely stalled. Nobody wants to buy or sell anymore in the United States, or there's people that does it, but there's a lot less, because they don't want to take on a 8%, the mortgage, because they can't afford it.
Right.
It's very simple. And that's what you're starting to see a lot of other places, especially in the big cities where, there's lots of money. And then when it's lots of money chasing assets, you get very high prices. So it's just a lose-lose scenario right now. And then, of course, I remember back in 2020, during COVID, like during the government lockdowns, you had Tiff McClem, the head of the Central Bank of Canada now. He came out and said to the population, this is how insane the central banker is. Comes out and says that, oh, don't worry, go out and lend as much as you can. Don't worry, we're going to hold interest rates at zero until the end of 2023. Well, now it's up at 5% almost. And now he came out and said that, oh, we got to watch about, we got some risks going on. But he was the one that came out and then told the people, like, let's go out on a debt bench, at the worst possible time. And then, of course, what they thought that, it's transitory, the inflation, by printing,
Yeah, right.
creating a whole bunch of currency and shoving it into the economy, and thinking that that's going to be transitory. It's taken a long time for that to come through. And what people also got to understand is like, oh, that inflation went away. No, it's like, no, there's still like 3, 4, 5, 6, 10% that it's still accumulating annually
Yeah.
that you're losing. And so people don't seem to understand that, inflation year over year went down, but you still have lost all of that inflation throughout the time, because inflation hasn't gone negative, but you lost a tremendous amount of purchasing power.
Yeah, there's so many vectors I could go with on this, John. And I'm making some notes, but let me go here. This is one that I don't think gets enough discussion. And, you can shoot holes in anything I say if you like. I mean, that's, I'm very free market and free speech oriented, as you well know. But I think one aspect about inflation that most people don't take into account, especially the mainstream financial press, is the psychology of inflation. So let me explain it a bit. So I just put up on my Twitter account, I think it was this week, that the UAW, United Auto Workers, were given a 25% wage increase. 25%, that's a freaking healthy wage increase. Now, here's my make-believe scenario. So I'm an auto worker. I got a 25% wage increase. I feel good. Inflation by the government's standards are only 8% here in the U.S., which is probably more like double that, according to John Williams, shadowstats.com. But I'll come back. These are 8%. So I feel pretty good. I'm covered, my family, But here's the problem. The plumber goes to the United Auto Worker, and he sees that this guy's got a 25% increase in wages. So he says, you know what? In my plumbing business, I'm going to go to 30% increase because I got to stay even with the United Auto Worker. I mean, after all, I got to feed my family, and inflation is whatever it said, but he got 25%. I'm going to 30%. Now, the auto mechanic that gets work done on his car, or does work on somebody's car, says, you know what? I can't afford these cheap wages I'm paying myself. I've got to increase 40% because last time I got the plumber in here, it was a 30% increase on me, and I got to be able to pay my bill. So I probably did a rather corny example, but this gets this psychology. And the reason I could say it with some authority is I lived it. Because when I got out of school and was 22 years old, this cost of living allowance was across the board in all the major corporations. If you were an auto worker, an aircraft worker, worked at 3M, Dow Chemical, any of the large, huge corps that had, massive corporate debt and could borrow, they were giving their employees wage increases all the time to keep them even with inflation. So it becomes a psychological event as much as anything else, according to me. What say you?
No, I totally agree. And, I described how hyperinflations could start. And a lot of times that's a psychological event. It's when people lose the trust in the currency. And of course, like I see this everywhere here in our province too, like we have massive strikes that's been going on, and especially in the government sector, people are getting like 13, 14, 15% raises over 1 to 3 year period. Of course, like what we don't understand is like it actually is to try to keep up with inflation, but now the inflation that you get from the CPI, and that we're watching is very manipulated, and so that's kind of why I believe it's manipulated, is to try to keep that down. But of course, the psychology would be that everybody wants a raise. Of course, like why wouldn't it make sense that I would have more because I've lost so much of my purchasing power? I'm struggling to make ends meet. Why wouldn't I want a lot more in salary to make my life okay to live again? And so you might have that, but then if you have the person that has good amount of money and then get a raise, they might buy a bigger home, and then like you get that cycle. So you could get some trickling of that psychological inflationary pressures that are coming out there from those heights. And then of course I remember, so I purchased a lot of alarm parts and cameras and so on. And that's supposed to be a very deflationary sector, okay? Like it's supposed to be very deflationary. Now those prices went up during 2021 to 2022, and they still have gone up. They've actually gone up about 100%. Okay, so like, see, the real inflation is down here. Now, what's going to end up happening as a business, I'm going to go out, and then when I do a quote for a customer, I'm not going to quote the old price, from 2 years ago. I'm going to quote you a new price, because or else I'm losing. I'm like I'm draining my balance sheet, my bottom line, because I would not be smart enough to follow the new pricing. And then I looked at one base metal that I use a lot, which is copper, for both electrical and for my network cabling and all that. Like that has gone up almost 120%. And what we've seen is it went up and then it went down. But guess what? It went down, like it went up 100%, came down 2%, and then went up another 20%. And so what is happening also is that we got to remember it's not only that, but it's also the labor that goes into creating these things, right? And so that's where it comes back to that we can yet another again see more price rises. Then I of course keep my eye on this on a monthly basis. My prices are for my customers when I do quotes and so on. And so you see a lot of that psychology is really trickling in, and you saw that even at my business. I didn't even ask for a raise, but the boss actually have given us several raises without like me even thinking of it. So it's psychological because they know that if they don't give a raise, so maybe we'll just jump to somewhere else that they've higher wages or something like that. But what's going to end up happening is when you have all that inflationary pressure on there, yeah, you get more money and all this things. It's all fun and games for a little while, but then prices rise again, and then if inflation goes up again, this could be a triple top inflation like you had in the 70s, right? And so if we're in that, we're down now, it's deflating a bit, but then all the wages and all these pressures come back again. What you could have is you could have another inflationary pressure that comes in that's even higher. And then what happens is that you will have a lot of people panicking because what's going to happen is the central banks, they're going to be desperate. They're going to have to raise interest rates like they did. They didn't want to, but they had to. And so they're going to raise interest rates to potentially higher levels again. And then so what's going to happen with that is that you'll get a huge pressure again, and then you're in the same boat again. And so you have this cycle, and it could happen within years now. This cycle where you have these panics, and at one point, what's going to end up happening is it goes too far where people have had their purchasing power destroyed too much and their salaries. Like in Venezuela, this is an interesting point to your salary point there, Dave, is in Venezuela at one point, I remember reading about 5 to 10,000% increase in salary raises. But at one point, this woman that worked for the government, she actually quit her government job, high-paying government job in Venezuela. She went on the street to sell coffee and made 10 times more. And so that's where you get those massive shocks. That could be a potential outcome here. Is that if you don't get the deflationary outcome, you then get the spiking of inflation to higher and higher levels. You could definitely have the outcomes, and then of course what will end up happening is that people that have their savings and everything in the currency, it's just losing more and more without having any clue what's going on, and it's. Even though we have an inflationary pressure and everybody seems to feel like that you're richer, you actually get poorer and poorer and poorer.
Well, we've got one more question. I got to wrap it up, but this is one I get often, and I've changed my opinion on it. Very practical. So do you think it is worth taking your stock certificates in printed form in your name and mailed to you so you actually have possession of that piece of paper? I've told my people no. I used to advocate that. In fact, when I started in the stock market early on, every mining company I own, I had that piece of paper in my hand. But those days are long gone. And if you take the certificate, you have to sign the back and mail it back to your broker or your bank. And then they have to put it back in the electronic system before you can sell it. And so if the system mucks up, it's an extra chore, an extra burden. I mean, what if the postal department's on strike? I mean, so many things could go wrong. I think it's better to keep it in street name, which you're the beneficiary of it, and you can mouse click it off. What do you think?
No, I think exactly like when it comes to those type of assets, and I have mining stocks and stocks in the commodities sector. I would just keep them there. Yeah. I know that they could potentially be a loss. You got to understand that could be a huge risk, of course. But yeah, just make sure that that's a risk that you have, that you're willing to take, and that if things goes really well, we might be fear mongering, and it's a wonderful world in 2-3 years. But I don't think so. But again, it's I think it's better to just take those risks and have that there, and like that's what I do anyways. And I think that's what actually even Doug Casey does it himself. Have said it. So uh, yeah, and like there's no point of trying to even get there. And can you even get a stock certificate these days?
Very difficult. Very, very difficult.
Yeah. Yeah, because like who owns the stock certificate most
Right.
likely is the DTCC or whoever
Exactly.
clearinghouse that sits on these. And so yeah, no, yeah, I don't think that's even worth it, to go through all that trouble to try to think that you own an asset. Now, if you actually were able to trade with corporations that are private, and are not on stock exchanges, if they were outside and you could hold a direct, share in the corporation, if they did, paper copies, and you could have a direct, connection, that's a little different. But and I for anything that's traded on any exchanges that are held in that street name, it's pretty much useless, I think, to try to get to a point where you hold anything in paper form. I think that's pretty much the zero.
Okay. I'm going to go ahead and close it out there, John.
Yep.
Thank you so much.
Yeah, but
Thank
it
you
was a
so much
pleasure.
for your time.
Yeah. Yeah, it was a pleasure, Dave, and I look forward to chatting with you further in the future.
Very good. Take care
Yeah.
now.
Yeah, have a good one.